This explainer. Look, today we're stepping far, far away from the chaotic noise of the cryptocurrency market. If you are totally exhausted by the laser eyes, the rocket ship emojis, and all that unrealistic moon math, well, you've definitely found the right place. We're going to unpack a highly disciplined investment strategy straight from a source called TheAbrahamCryptoLand, which is entirely dedicated to cultivating a truly resilient investor's mindset. We're going to contrast the typical, frantic crypto hype with a deeply grounded, methodical approach to building a portfolio. And we'll be focusing specifically on how to manage a position in Bitcoin Cash.
Okay, let's dive into this. The source material hits this point like a ton of bricks right out of the gate. Absolutely no one can predict the future price of Bitcoin, Ethereum, or Bitcoin Cash. Now, I know it sounds incredibly obvious, but honestly, it is perhaps the hardest truth for any investor to truly internalize. Human psychology naturally rebels against this, right? We crave certainty. We want gurus with flashy charts to tell us exactly when we're going to be rich. But the core philosophy here requires you to radically accept absolute uncertainty. Acknowledging that you literally cannot predict the future isn't a weakness. It's actually the foundational step you need to build a framework that survives market volatility.
So, here's our roadmap for today. Number 1, beyond price predictions. Number 2, managing the uncontrollable. Number 3, the 10% strategy. Number 4, logic over emotion. And finally, number 5, the journey ahead.
Let's start with Section 1, Beyond Price Predictions.
Here is the deal. You cannot control the stormy, chaotic nature of market action. You just can't. You can't force a chart to go up, you can't stop a massive institutional sell-off, and there is no way you can predict a sudden regulatory crackdown. Staring at price tickers and trying to mentally will them higher is, quite frankly, an absolute waste of your energy. Your true power, and the only thing that actually matters, is your own investor action. The source material emphasizes that your zone of control is limited strictly to your own decisions, your risk management, and how you deploy your capital. Shifting your focus entirely from what the market is doing to what you are doing is the definitive mindset shift we're talking about today.
Moving on to Section 2, Managing the Uncontrollable.
You know, most people enter the crypto space completely blinded by the upside. They're sitting there calculating how many millions they'll make if a coin hits some magical price target, but they totally ignore the floor falling out from under them. The author demands a strict internal audit before buying any asset, starting with this fundamental question: how much risk am I taking? It's all about aggressively quantifying your downside right from the start. You've got to understand the volatility profile of the asset, the security of the network, and the broader macroeconomic environment before you even let yourself think about potential profits.
And right after that, you have to force yourself into the incredibly uncomfortable mindset of total failure. Ask yourself honestly, what happens if my idea just does not work? What happens if the adoption of Bitcoin Cash completely stalls out or a catastrophic bug is found? If this project tanks to absolute zero, are you financially ruined? Are you going to miss your rent payment? Or is it simply a calculated setback in a broader, well-diversified portfolio? Because if you're just blindly hoping for the best without a contingency plan for the worst, well, you aren't investing, you're gambling.
Which brings us to the final question in this internal checklist, bridging the gap between theoretical risk and hard reality. How much capital am I actually willing to put into this investment? You have to clearly define your absolute unbreakable limit before you ever experience the adrenaline rush of clicking that buy button. Setting this boundary while you're still in a calm, rational state acts as an inoculation against the FOMO, that fear of missing out that inevitably strikes when markets start moving violently.
Let's jump into Section 3, the 10% strategy.
Now, what's really interesting about this strategy is how the author actually translates all that psychological theory into strict mathematical reality. They dedicate exactly 10% of their crypto allocation to Bitcoin Cash, while the other 90% is distributed across the rest of their portfolio. So why exactly 10%? Well, it's a perfect exercise in asymmetric risk. 10% is a large enough slice to give you highly meaningful upside if Bitcoin Cash achieves global adoption and the price appreciates. Yet, and this is the crucial part, it is small enough that if the absolute worst-case scenario happens and the asset goes to zero, your overarching portfolio comfortably survives. It's aggressive potential, perfectly balanced by protective diversification.
Think about an incredible project you've researched in the past. Maybe the tech was flawless, the team was brilliant, the use case was revolutionary. But listen, no matter how good those fundamentals are on paper, a good opportunity instantly becomes a bad investment if your personal risk is not managed properly. If you over-leverage or bet your life savings on that single sure thing, the inevitable volatility of crypto is going to shake you out. A genius idea is completely useless if poor risk management forces you to sell at a massive loss just to survive.
Now, having discipline doesn't mean you have to be blindly stubborn. A rigid 10% rule isn't etched in stone forever, but changing it requires intense justification. The source points out that having a plan means having a logical, predefined reason for making adjustments. Allocation should really only be reviewed because overarching markets change, conditions change, or completely new, verified information appears. There is a massive difference between executing a logical pivot based on new data and emotionally panic selling just because you saw a scary red candle on the daily chart. This leads perfectly into Section 4, Logic over Emotion.
And this brilliantly illustrates the real battle here. The ultimate adversary in your investing journey isn't a regulatory body or a competing blockchain, it's your own brain. When the rocket ships appear on social media and prices surge, confidence mutates into dangerous arrogance. Investors suddenly feel like financial geniuses, which leads them to ignore their limits and over-leverage at the exact top of the market. Conversely, when prices inevitably crater, sheer terror takes the wheel. The asset they loved at $500 is suddenly terrifying at $200, and they panic sell at the absolute bottom. Unchecked, your emotions will mathematically guarantee you buy high and sell low.
So the crucial point is this powerful anchor quote right here. Successful investing is not about following emotions, it is about following a process. A predefined system acts as an emergency brake on your absolute worst impulses. If the market goes higher, you execute the strategy. If the market crashes and burns, you execute the strategy. Process is literally the only reliable shield you have against the twin destroyers of wealth, greed and panic.
Finally, let's look at Section 5, the journey ahead. Because honestly, buying that 10% allocation, that is just the starting line. The author outlines 4 distinct tactical phases that make up the real grueling work of an investor. And these are topics they plan to dive deeply into in future updates. Phase 1 is planning the accumulation without rushing. Phase 2 is deciding how to approach different psychological price levels. Phase 3 is the true crucible, managing your nerve during a brutal 40% market correction without capitulating. And finally, Phase 4, having the extreme discipline required to actually take and divide profits when everyone around you is screaming that the price will go up forever.
Successfully navigating those 4 phases requires what we can call the investor mindset toolkit. Patience ensures you don't arbitrarily increase your allocation to 50% just because you're bored or feeling lucky. Discipline ensures you stick to the plan even when it's wildly unpopular. And relentless risk management guarantees you actually live to play another day. These aren't just empty buzzwords. They are the literal survival mechanisms that prioritize long-term generational wealth over flashy short-term screenshots of temporary gains.
So what does this all mean for you? Let's leave off with a thought that forces a real audit of your own strategy. Are you managing your crypto journey, or are your emotions managing you? Take a hard, objective look at your portfolio today. If you don't have strict, mathematically defined parameters for your allocations and pre-written plans for both massive crashes and massive pumps, you're likely just letting the chaos of the market dictate your financial future. I highly recommend diving into the source material at TheAbrahamCryptoLand for more on this disciplined approach. Until then, refine your process, secure your limits, and I will catch you in the next